Today I'm going to be sharing some charts from my holdings in my portfolio at the close of February 20th, 2026. I'll share with you what I'm observing on the charts and how they help me make any decisions for these holdings. We'll begin with the general market overview, and we'll take a look at the earnings for holdings in my portfolio since we're in the midst of earnings season. If you enjoy videos like this, please subscribe to the channel and set your notifications for future videos. Also, be sure to press that like button to help support the channel. Let's get started. We'll start off with the major indexes, looking at a 1-week view. So the Dow Transport Average was up the most at 2.57%. Remember that last week this was at the bottom of the leaderboard, and 2 weeks ago it was at the top of the leaderboard. So this one is definitely moving up and down as we move through each week's trading. The semiconductor index followed at 1.5%. Mid caps were up 1.25%. The NASDAQ 100 was up 1.13%, followed by the S&P 500 at just over 1%. It did outperform the S&P Equal Weighted Index this week, where that one was up 0.55%. S&P 600, or the small cap index, was up 0.5%. And the laggard this week, even though it was up for the week, was the Dow Jones Industrial Average, up 0.25%. When we look at the sector charts, we'll also use a 1-week view. Communication services came out on top at a little over 1.9% increase this week. Industrials were up 1.75%. Financials were up 1.6%. They all outperformed the S&P 500. Those that underperformed the S&P 500 was consumer discretionary, up just a little over 1%. Energy was up just about 1%. Technology was 0.95%. Real estate was green, with an up week of 0.14%. And then those that underperformed this week were utilities at minus 0.37%, the healthcare sector at minus 0.5%, materials at 0.6%, and finally the laggard this week was consumer staples, which had been performing very well through the early part of this year. This is the S&P 500 over a 1-year period. We can see that pretty much since the end of October that we've been trading sideways. That makes some of the data a little bit hard to see, so we're going to move into a 6-month view. We can see that the S&P 500 has been oscillating around the 20-day moving average, which is this gold-colored line here. It's also been trading below and slightly above the 50-day moving average, which is this blue line. It is leveled off over the last couple of weeks or so. The 20-day is declining. We have 2 points where we have some support. We'll keep an eye on these levels because it has been tested 2 times since the beginning of the year. We also find that we have resistance that's been tested multiple times at around 6,976 or so. The 200-day has climbed to what we had as a previous line of support that had been tested 2 times at around 65.50. The S&P is currently trading about 5% above that 200-day moving average. We'll move down to the CBOE put call ratio for equities. We can see that the 5-day moving average has been increasing for 2 or 3 weeks. We did see a slight decline in that average this past week, but this is considered elevated at this point. So market participants are buying more puts than calls at the moment, indicating that they're expecting some downward pressure on prices for the S&P 500. We have an RSI that is sitting right at neutral, slightly above neutral at 51. The PPO has moved into negative territory and is trading below the signal line. Money flow is currently bullish on the S&P 500. Lastly, we'll take a look at the VIX. We can see that the VIX has been increasing since the end of last year. We had broke out above this 20 line, which indicates significant volatility. We did get up to 21.77 on February the 4th. We did have another spike on February the 12th where we got up over 20, and one more slight elevation just slightly above 20 on February the 19th, and currently we're sitting at 1909. So overall the market is in a cautious stance. Next we'll take a look at the earnings results for the holdings in my portfolio. Approximately 3/4 of them have reported so far, and I keep an estimate of the revenue. The actual, we can see that they beat on average by 1.32% on revenue. And I also keep the earnings estimate and the earnings actual, and we can see that these have had a beat of 14, closer to 15% this quarter. I also keep track of what the relative strength from the charts as we move into earnings, and whether the price trend overall is in an uptrend, whether it's accumulation or downtrend, whether it's consolidating. I also keep track of the implied move for each one of these, and I report that to you in the short videos that I do on YouTube, so you have an estimate of what the implied move is. I also keep track of the short interest and the price at the close before their earnings, and then I collect the initial response, what was the initial reaction on the price following their earnings, and then I track that for 1 week following the earnings, and then finally 2 weeks later. So what we can see is that while most have beaten on revenue, so 83% was a beat, inline was 0. For earnings, the beat rate was 64%, while inline was 11%, so 75 were either inline or a beat. And despite that, the initial reaction was positive only 39% of the time. 1 week later, it looks to be 50%, and then 2 weeks later, which I don't have all the data for the 1 week or 2 weeks later, it was only 39% positive. So this appears to be one of those quarters where a company can beat their revenue and earnings estimates, but not necessarily have a good or positive price reaction. So a company really has to beat or provide really good guidance for it to be positive this particular quarter. If we look at what's upcoming for this week, we have 9 that will be reporting this week. The biggest one will be NVIDIA on Wednesday after the market close. I will be collecting and reporting the relative strength, the price trend. I will give you the implied move for each one of these companies in short videos this week, so be on the lookout for those. So the first chart we'll look at is Agree Realty, symbol ADC, in the 1-year daily price chart. REITs are expected to perform second best as far as a sector this year, following only the technology sector as far as price performance this year. We can see that they had a really nice price run since the beginning of February. I had a price target on this one based on this pattern that I saw right here, and I reported that on February the 5th that I thought it could reach $77 to $78. Last Friday it did close above that price target. We have had a little pullback this particular week. The beginning of the week we did have a pretty significant pullback. I guess it was in the middle of the week. And then it did recover over the next 3 days to the closing price of $78.24. We did have a little slight uptick on the 10-year Treasury rate, keeping in mind that these REITs are sensitive to that particular rate because they need to borrow money to grow their business, or they need to provide a share offering to collect money to invest in future businesses. So we do need to keep an eye on that 10-year with REITs. They did get into an overbought condition earlier in the week. They did pull back and held that 60 line, and currently increasing on the RSI, currently at 64. We've had a buy signal on this one since February the 2nd. The PPO is looking very strong at the moment, leveled out over the last 3 days, but still above the signal line. We can also see that they are under pretty good accumulation over the past year. Once again, we did have a slight pullback, but it is improving towards the end of the week. We can also see that the money flow is currently positive. ADC has a portfolio rank of 8 in my portfolio. The overall trend is in accumulation. They are up 8.62% for the year to date. There are 10 analysts that cover Agree Realty with a 1-year price target of $81.05 and a range between $75 and $84.50. They do have a dividend yield of 4.02% and a 5-year dividend growth rate of 3.42%. When we look at the weekly chart, we can see that they were up 0.2% for the week. That did represent a 52-week high. This is Amazon in the 1-year daily price chart. We can see that they had a big sell-off after their last earnings, basically due to their CapEx expenditures for this year that are planned. They did come down and test support that had been established clear back in May and also March of last year. They did come down and find support at that level and are now recovering above both of these support levels. The 50-day is trailing downward. The 200-day is somewhat leveled off. The 21-day is also still declining. I did pick up a few shares last week, actually 2 weeks ago, and I do plan to have them on my buy list for this week. We do see that the RSI has come out of oversold territory and has moved back near the 40 line, currently at 39.34. We can also see that the PPO has been suffering. It is leveling off and starting to curl over. I expect within the next few days or maybe a week that we will get a crossover above this signal line. They had been in some distribution, but this past week they moved back into accumulation, and the money flow is currently in bullish territory. They have a portfolio rank of 21 in my portfolio. I have a blended intrinsic value on them of $284.63 per share. The overall trend is in distribution. There are 44 analysts that cover Amazon with a 1-year price target of $279.59, with a range between $175 and $325. Year to date, they are down 8.97%. If we move to the weekly chart, we can see that they closed the week up 5.69%. The RSI on the weekly view is also coming out of oversold territory and moving higher. And the PPO is in bearish territory, but on the weekly view does seem to be nearing a leveling off period. This is Ares Capital, symbol ARCC, in a 1-year daily price chart. They have a portfolio rank of 17 in my portfolio. The overall trend is in a downtrend. They have a book value of $19.94, and that's where I have this blue or cyan colored line, just so I can keep track of where their book value is per share. There are 9 analysts that cover ARCC with a 1-year price target of $22.11 and a range between $20 and $23.50. They do pay a dividend of 10.03% with a dividend growth rate of 3.71% on average over the last 5 years. There have been some news reports over the past year that have affected business development corporations or companies like ARCC. Earlier, or in the middle of last year, there were some reports about credit worthiness of some of the loans that had been made by these business development companies. That did cause a sell-off in ARCC. They did reach a low of $18.35. After that point, they did have a slight recovery back up to highs of about $21.14. And then there was a report that BlackRock Fund TCP Capital had reported a 19% reduction in their net asset value, and that reinitiated credit worthiness concerns. I did put out a video on that topic on February the 4th if you want some more details. And then just this past week, Blue Owl Capital had placed some restrictions on withdrawals from one of their private funds, and that led to additional concerns. So I like to buy when the price is trading under their book value, keeping in mind that these credit worthiness concerns are going to put some downward pressure on these business development companies. None of these have been specific to Ares Capital that I am aware of. Most of them are related to other companies, but it still puts downward pressure on this company. But it's a good time, in my opinion, if you're willing to take the risk to pick up shares when they're trading under their book value. So I had sold some shares when they were trading at higher prices, and as they've moved down below their book value, I have been picking up shares. I've also been selling puts on this particular holding. On February the 6th, I did sell 2 puts with a strike price of 19 that expired on the 20th past Friday. They closed at $19.50, so those options became worthless, and I was able to collect the premium on those 2 puts of $50.97 after fees. They are down year to date 5.34%. We do have an RSI that's sitting right around 40. We have a PPO that's currently in bearish territory. The 21-day is moving downward. The 5-day moving average is moving downward at the moment. The 200-day is sitting at about $20.45, but is somewhat flat at the moment. So I think there's an opportunity to have a recovery over time on this. But while I'm waiting, I will be collecting that dividend of 10.03%. If we look at them on the weekly chart, we can also see that they have an RSI of 39. They are in bearish territory on the weekly chart. This is over 3 years. We can see that the accumulation is basically very near a 3-year high. On the weekly data, we can see that the money flow has been neutral or negative since about the 6th of October of last year. If we look at my share transactions, I've held this since March of 2021. The tranches that are in the green shaded color are those that I have sold. Those in white are ones that are still open. So I have 900 shares currently of ARCC. I've had a capital return on those shares of 7.4%. I've received dividends that contributed 20.7% of the total return, and the options premium has contributed about 0.4%. So the total return has been about 28.6%. My current investment has a return of 57.7%, 29.2% annualized. A simple buy and hold strategy would have been 22.4% or 4% annualized. I have traded this one 31 times. 12 are still open, 19 are closed. 26 have been winning trades, 5 have been losing trades. So my total gain per trade is $473.89. For the 5 trades that were losers, I lost only $31.50. That gives me a win rate of 84% and a gain to loss ratio of 15.04 to 1. This is CorMedix, symbol CRMD in the 1-year daily price chart. I had first started buying shares on this one around the beginning of December. So my average cost is still above where it's currently trading. My average cost is around $8.80. My net cost after options is $8.56. So I'm still underwater on both of those metrics. On December the 8th, they did issue lower than expected guidance for the full year 2026. And that was basically related to their Medicare reimbursements on their primary products. So that caused a pretty significant decline in the price. They have somewhat traded sideways with some up and down movement. They did find support at this $6.80 per share line. They did bounce off of that. moved back up to about 853 and have been declining back to their current price of $7.03. On the 2nd of February, they did announce that they had authorized a $75 million buyback authorization through the year end 2027. So if they execute on that buyback, then that would reduce their share count by about 10%. The 200-day is starting to decline. The 50-day is declining. The 21-day is declining. I'll see if they can continue to find support at this level. If they do not, then the next level of support would be around $5.63. So I'm of the mind that they will maintain support around $7 until we get some clarification on their future activity. They do have an RSI that is below 40, currently at 34.2, so had been in an oversold condition. They moved out and are staying out of that oversold condition. We did get a buy signal at the end of January, but this is in bearish territory. They have a portfolio rank of 40 in my portfolio. I've calculated a blended intrinsic value of $25.07. There are 7 analysts that cover CorMedix with an average price target of $15.29 and a range between $12 and $22. Those estimates held steady this week compared to last week. Year to date, they are down 39.55%. On the 14th of January, I had sold a $7 put with an expiration of February the 20th, so that expired worthless, so I was able to keep that premium of $49.48 after fees. If we look at the weekly chart, they were down 4.22%. They are slightly below 40 on the RSI line, currently at 36.81. In the weekly view, we are on a sell signal since the end of last year, and that seems to be getting a little bit worse, but the difference between these two lines, the red line being the signal line, we are seeing a slight improvement over the last few weeks. Money flow has been negative on this one. I would really say since about the 18th of February of last year, we did have a few weeks where they were in bullish territory, but for the most part, the money flow has been negative on this one. If we look at my trade analysis, I've made 3 trades. The last one, I actually had a put that was exercised. So I had bought that with a strike price of $9. So I'm underwater on that particular trade. So I've lost about 19.8% on this investment so far. I do have options that have contributed back 3%. So my current return is minus 16.8%. So on this one, my losses per trade are $347.10. I don't have any that are winning at the moment. So my win rate is 0% and the gain to loss ratio is undefined on CorMedix. So my plan for the upcoming weeks on CorMedix is to keep an eye on the options to see where there's some opportunities. I think with a strike price of 7, if it did get exercised, I think that's a fair price to pick up CRMD since it is finding support at around 680. Another option is to just pick a lower strike price maybe around $6. So I'll be looking for some opportunities in the options chain on this one and see if I can reduce my overall cost with options premium. This is Alphabet, symbol GOOG in the 1-year daily price chart. Google ranks 20th in my portfolio. Google did have a sell-off after their most recent announcement, basically on the CapEx expenditures, where they're expected to be about $180 billion this year. A lot of the hyperscalers have announced large CapEx values, and even Meta, which isn't a hyperscaler, but still announced a very large CapEx number, took a hit on those announcements, and investors are concerned about the return on that investment. They are down as of Friday's close 8.7% from the February 2nd high, and that was following a drop of 11.2% last week, which was in correction territory. And now that they've moved back above that 10% loss, they have moved out of correction territory as of Friday's close. I have a blended intrinsic value on Google of $319.83. Their overall trend is in consolidation. There are 44 analysts that cover Alphabet with an average price target of $348 in a range between $190 and $420, which was the same as the previous week. So the 5-day moving average is declining at the moment. The 21-day moving average has dropped below the 50-day moving average. Both of those are declining. So I don't know if this bump that they got on Friday of 3.75% is going to be sustainable. I'm being cautious about my buys at the moment. They did drop below my trim point, which I had set at $325.71. I did not trim immediately because there has been at least 2 instances prior where they dropped below that trim point, and I use chandelier exits to identify those trim points. But there were 2 prior instances where it dropped below the trim point for only a day and then resumed price increases. So I've been a little bit more cautious about trimming. Here lately, they did drop below my trim point, but I waited until they had a sustained close below the 50-day, and that's when I actually decided to trim a few shares. I trimmed them at 312, and then since then I bought 4 of those shares back at lower prices than I was able to sell them, so that helps my returns, and we can look at my trades here shortly. Year to date, they are only up 0.35%. I had explained in several prior videos that I had been concerned about how far extended above their 200-day moving average they were. And even at Friday's close, they are still above their 200-day moving average by 27.85%. I also mentioned that they had bearish negative divergence on the RSI and bearish negative divergence on the PPO. So those are 2 indicators that I was being a bit cautious on. If we look at the weekly chart, we can see that they are maintaining above an RSI of 60. We had been on a sell signal since about the 22nd of December. Accumulation is still moving higher. The money flow has gone from a peak on the 3rd of November closer down to the neutral zone at the moment. So another reason for some cautiousness. We'll take a look at my trade analysis. So I entered into Google on May 9th of last year. I have a total of 44 shares. I've had a capital appreciation of 44.9%. Had dividends of 0.3%. So my total return on all of my buys are 45%, but my current return is 76%, and that would be compared to a simple buy and hold at 48.3%. So my trades have paid off by trimming and buying back at lower prices. I do have a total of 11 trades. 7 of those trades are open. 4 trades are closed. 9 of those have been winning trades. 2 have been losing trades. On my winning trades, I have an average gain of $705.55. And on the 2 losses, they've been an average of $108.79. That gives me a win rate of 82% and a gain to loss ratio of 6.49 to 1. Next, we'll look at Hess Midstream Partners, symbol HESM, and the 1-year daily price chart. They have a portfolio rank of 11 in my portfolio. I have a blended intrinsic value on Hess at $47.31. They have moved from an overall trend of consolidation to accumulation. On the 19th of September, they announced that Chevron was reducing the rig count from 4 to 3. And UBS had downgraded on the potential of rig pullbacks about 9 calendar days earlier. So I had trimmed some shares at the higher prices, and once the announcement was made, I started backfilling those shares back into my portfolio. And since then, they have recovered back to close the gap that was formed on September the 19th. So they are above that support level, and they closed on Friday's close, they closed above that. They were up 0.99% on Friday. They are overbought at the moment with an RSI of 73. We've had a buy signal on the PPO on Hess Midstream since about the 13th of January. They are trading above an upward sloping 5-day, 21-day, 50-day. They did cross above the 200-day, which was at Friday's close was at 35, and the 21-day has crossed above that 200-day. If we scroll down and look at accumulation, we can see that they've moved from basically consolidation over the past several months to an accumulation phase at the moment. The money flow is currently positive and appears to be getting stronger on Hess Midstream. On the 20th, where they did close up, that was a 65-day swing high. They do have a dividend yield of 8.07% and a 5-year dividend growth rate of 11.05%. They are up year to date 9.83%. There are 7 analysts that cover Hess Midstream with a 1-year price target of $41.43 and a range between 36 and 48, and that is the same as the prior week. If we look at the weekly data for Hess Midstream. They have crossed above the 60 line. They are not overbought on the weekly view. And we've had a buy signal since about the 24th of November. And we are seeing accumulation as well in the weekly view, and that's currently at about a 3-year high. The money flow on the weekly view is also positive and growing stronger. If we look at my share transaction analysis for Hess Midstream, I first entered into this name in June of 2024. I have traded it several times over that time frame. I currently have 820 shares, and by the looks of the accumulation on both the daily and weekly views, it may be time to actually add a few shares. But I've had a capital appreciation of 5.4%. They have paid out dividends of 7.6% for a total return of 13%. Now, when we look at my current return, it's actually 17.1%, and a simple buy and hold would have been 12.1%. My current investment, I have a $35.53 cost per share on average. I have traded this one 31 times, 23 are open trades. 8 are closed. 29 of those have been winning trades and 2 are losing trades. On average, the winning trades have provided $183.00 gain, while the 2 losses have averaged only 37.5. That gives me a win rate of 94 and a gain to loss ratio of 4.88 to 1. Next, we'll look at Meta Platforms, symbol META in the 1-year daily price chart. They do have a 21-day that is declining at the moment, a 50-day that had been increasing but is rolled over and is decreasing. Friday's close, it looked like they traded just below that 50-day moving average. They are trading right around my average cost per share at the moment. We do have a support line down at around 601, and we have a resistance point at the gap down on the 30th of October after their earnings. And then they had an earnings report on the 29th of January where they gapped up pretty solidly, but they've been on a steady decline since that point. They do have an RSI that is sitting right around neutral, just below the 50 line. We've had a sell signal on them since about the 9th of February. They had been in pretty steady distribution over the past 6 to 7 months, but I am seeing a bit of accumulation this past week, although the money flow has not really moved out of what I would call neutral territory. They have a portfolio rank of 25 in my portfolio. I have a blended intrinsic value calculation of $1,035.98. There are 39 analysts that have an average price target of $835.59. That is down slightly from last week's estimate at $838.08. The range did not change, and that sits from 645 up to 1,144. They are down 11% from their most recent high, so they are still in correction territory. And their year-to-date return so far is minus 0.67%. When we move to the weekly chart, we can see that they were up 2.48%. The RSI is about where it is on the daily view. We have had a buy signal on them since about the 20th of January. Prior to that, we had been on a sell notice since about the 25th of August of last year, all the way until mid-December of last year. In the weekly view, we can see that they've been under steady accumulation, but they're not quite back to their 3-year highs, which would have been set on about June the 2nd of last year. Next, we'll look at Altria Group, symbol MO in the daily 1-year price chart. We can see that they've really been showing some strength since the beginning of the year. They have a portfolio rank of 4 in my portfolio. The overall trend is in accumulation. I have a blended intrinsic value on Altria of $73.65. We do have a cup with handle formation that is formed. So on February the 5th, I had set a price target of around $72.50, and they are making progress towards that price level. On Thursday's close, they were up 1.83%. That was an all-time high for Altria. On Friday, they did pull back slightly by 0.62%. I had bought 50 shares at $65.59, going overweight on this position. I did trim those shares probably a little bit early, but I was afraid we were starting to see a rotation out of staples. So I did trim those shares at $66.34, bringing my portfolio allocation back to equal weight. They are up year to date 17.19%. They have a dividend yield of 6.27% and a 5-year dividend growth rate of 4.12%. There are 8 analysts that cover Altria with a 1-year price target of $62. They're already trading above that price. The range of estimates range from $50 to $72, which was the same as the previous week. I have raised my trim point to $64.28. That is raised from $63.77 last week. They are trading generally above a 5-day moving average. We have a 21-day exponential moving average that is increasing. We did get a golden cross where the 50-day crosses above the 200, and that was right around the 17th of February. The 200-day is also increasing. They did close above a resistance point this week, so that has turned into support, and now we're really in blue sky territory where they are trading at near all-time highs. The RSI did get to 68. It was overbought for a day or two. It has moved out of overbought. We've had a buy signal since about the 12th of January on this name. We can see that they are under accumulation at the moment, and the money flow is currently bullish. When we switch to the weekly chart, they were up about 0.5% this week. They are in overbought territory on the weekly view. We've had a buy signal since about the 12th of January. The money flow is also positive on this name, and accumulation is at 3-year highs. When we look at Altria in fast graphs over this 13-year time frame, we do see they have an EPS yield of 8.06%, showing good value. They have a dividend yield of the 6.27%. Over this time frame, they have grown their adjusted operating earnings by 6.1%. Fastgraphs calculates their fair value at 15 times, and their normal PE is 12.89 times. We can see that they are trading both below their normal multiple, the blue line, and their fair value, the gold-colored line. They are expected to grow their earnings this year by 4%, according to the analyst. The following year will be 3% and then 4% in 2028. Next, we'll look at NNN REIT, symbol NNN. So we have to keep an eye on that 10-year Treasury. The 10-year had been steadily decreasing, which helps with the pricing on REITs. This past week, we did see a slight uptick in the 10-year Treasury rate. NNN has a portfolio rank of 12 in my portfolio. The overall trend is showing accumulation. On the 17th, they did intraday. They touched an all-time high, which is this blue line. I have that annotated so I can keep an eye on that particular level. They are trading above an upward sloping 5-day, 21-day. We did get a golden cross on this one, where the 50-day crosses above the 200, and both of those are upward sloping at the moment. Year to date, they are up 11.91%. There are 6 analysts that cover NNN with a 1-year price target of $43.33 and a range between $43 and $44. So they're currently trading above the analyst's highest estimate at the moment. And those estimates were the same as they were last week. They do pay a dividend yield of 5.41%. And they have a 5-year dividend growth rate of 2.78%. The RSI is currently above the 60 line. They were overbought for about a week. They did come out of that overbought condition, and they currently are sitting at about 66.77 on the RSI. We've had a buy signal on them since the 3rd of February. We can see that the accumulation is beginning to increase for this name, and the money flow is currently in bullish territory. If we move to the weekly view, we can see that they were up only 0.02%. We can see that the RSI hasn't quite reached an overbought condition. They've been on a buy signal since the 5th of January in the weekly view. The accumulation looks to be at a near 3-year high, and in the weekly view, we also see money flow is positive. This is Realty Income, symbol O, the monthly dividend payer. We can see they are trading above an upward sloping 5, 21-day, 50-day, and 200-day. This one is ranked number 1 in my portfolio, and generally they're in an overall uptrend. They did have a blue sky breakout on February the 4th, and Tuesday they did close at an all-time high. They pulled back slightly on the 18th of February, but then started a bit of a recovery, closing at 66.14 on Friday. Once again, this is a REIT, so we keep an eye on that 10-year Treasury rate. They were overbought on the RSI. Last week, they did move out of overbought, and then towards the end of the week, moved back into overbought territory. We've had a buy signal on them since the 4th of February, And if you ignore this 1 week where it was trading sideways, we've actually had a buy signal on them since the end of December. We can also see very strong accumulation over the past several weeks. We can also see that the money flow is currently bullish. They pay a dividend of 4.90%. They have a 5-year dividend growth rate of 3.53%. There are 12 analysts that cover Realty Income with a price target of $63.17 and a range between $60 and $68, which is the same as last week. On the 4th of February, I calculated a price target of $67.68 based on this cup with handle pattern. We are making progress towards that target, just trading less than $1 away from the lower end of that price target. When we look at the weekly chart, we can see that they were up 0.73% for the week. That was an all-time high weekly close. Realty Income is trading slightly above their fair value according to fast graphs now that we're starting to see declines in that 10-year treasury rate. When that treasury rate began to increase, REITs were hit pretty hard on the pricing, so they dropped below their fair value. Did go up above it a little bit in 2024 when those rates started coming down, when it looks like we were going to be higher for longer on interest rates. Then it dropped back down, but has since recovered and is now trading above that fair value line. They have an AFFO yield of 6.48%, a dividend yield of 4.9%. Over this time frame, they grow their AFFO by about 4.44%. Fair value is 15 times the orange line, and the normal price to AFFO ratio is 18.25 times over this 13-year time frame. REITs tend to grow their earnings fairly slowly, or their AFFO, so Realty Income, which is one of the largest REITs, grows their earnings at about 3% per year. Next, we'll look at OneOK, symbol OKE. They have been performing very well after a pretty lengthy downtrend over the past year and a quarter. They did finally reverse that downtrend after they reached lows at around $64. They have now recovered to $87.33 on Friday. They have managed to break out above some downtrend lines. They've been holding steady and trading right along that 5-day moving average. The 21-day exponential moving average is increasing. We did get a golden cross on this name on about the 5th of February. That's where the 50-day crosses above the 200-day. The 200-day had been declining, but we are getting a slight uptick in that 200-day moving average at the moment. They have a portfolio rank of 32 in my portfolio. The overall trend is showing accumulation. On Thursday, they did hit a 65-day swing high. I have a trim point on them at $82.65, and that is up from $80.56 last week. They do have a dividend yield of 4.90% and a 5-year dividend growth rate of 2.15%. They are up 18.82% year to date. There are 15 analysts that cover OneOK with a 1-year price target of $89.07, with a range between $75 and $110, and that is the same as last week. They do show an RSI that is overbought at the moment. We've had a buy signal on them since about the 21st of January, and we are seeing a slight uptick in that accumulation, and the money flow is bullish at the moment. When we switch to the weekly view, we can see that they closed the week up at 1.42%. They are also in overbought territory on the RSI, and we've had a buy signal on this name since the 10th of November. The money flow is also positive on the 3-year chart, and we can see that accumulation is at a 3-year high. This weekly close does represent a 13-week swing high. When we look at OneOK in the fast graphs, we can see that they have moved above their fair value at the moment. They do have an EPS yield of 6.28%, that dividend yield at 4.93. Over this time frame, they have grown their adjusted operating earnings at 15.02%, giving them a fair value ratio of 15.02 times. The normal market multiple is 21.6 times. We'll find out when they report their earnings. Their growth rate for 2025, it's expected to be 5%. The analysts are expecting a 7% growth in 2026, 8% growth in 2027, followed by 14% growth in 2028. Next, we'll look at AT&T, symbol T. We're going to start out with an 18-year view because they do have an 18-year trend channel that they have tended to trade within that channel. They did drop out of that channel in 2023, came back into it at the beginning of 2024, and have moved closer to the top of the trend channel. They did have a slight pullback in 2025 and are now making progress back towards the upper end of that trend channel. We also have a 1-year trend channel. They traded within that from about April until September. Then they fell out of that shorter term trend channel and traded for basically the last quarter and a month or two, but have since moved back into that 1-year trend channel. Then if we just look at the 1-year daily price chart, we can see where they dropped out of that trend channel as they declined in price from about 29 down to about 22. I put a Fibonacci retracement levels over here so we could look at these resistance levels as it began to make its run higher, and it basically just went right through all of those resistance levels. It didn't quite make it back to 100% retracement, back to this high that we saw in September of last year. I did trim 100 shares, let's see, on the 17th at $28.81. They did get into an overbought condition on the RSI. They have moved out of that overbought situation, but we are getting very close to a sell signal on AT&T. So that's why I decided to trim those 100 shares. We can see that the money flow is currently in bullish territory. They pay a dividend of 3.97%, and they have a negative 5-year growth rate because they did cut their dividend at one point. Overall, they are in accumulation. I'm a little bit concerned about this downtrend that we're seeing here. So that's something that we are going to have to keep our eye on. There are 18 analysts that cover AT&T with an average price target of $30.39, and a range between $26 and 34 cents. They are up year to date 12.64%. When we look at the weekly chart, we can see they were down 2.47%. They are trading right at the 60 RSI level. We are still in a buy condition on AT&T since about the 20th of January. We can see that their accumulation is near a 3-year all-time high. On the weekly view, we did move into bearish territory on the money flow. We are currently in neutral territory. If we look at AT&T and Fastgraphs, we can see they have an EPS yield of 7.67%, dividend yield of 3.97%. They've grown their earnings over this 13-year time frame at 2.63%. Fair value is 13.75 times, and their normal PE is only 9.97 times. They are currently trading just below their fair value. They've had a 3-year contraction in their earnings, but analysts are expecting them to return to growth for the next 3 years, 9% for 2026, 10% for 2027, and 13% for 2028. Look at my share transaction analysis. I've held T since December of 2020. I've traded it several times over the years. I currently have 600 shares. They've returned about 19.1% in capital appreciation, 16.7% in dividends. I have lost some money in the options, but the total return has been 34.5%. I actually have a negative cost per share because all of my capital has been returned to me at this point. I have traded this one a total of 25 times. 5 of those trades are still open. 20 have been closed. 16 have been winning trades. 9 have been losing trades. For the 16 winning trades, it's been on average a gain of $1,777 per trade. And on the losing trades, I've limited my losses to $562 on those 9 trades. That gives me a win rate of 64 and a gain to loss ratio of 3.16 to 1. Next, we'll look at UPS in the 1-year daily price chart. I have a portfolio rank of 19th in my portfolio. The overall trend is in an uptrend. I have a blended intrinsic value calculation on them of $129.85. They are up year to date 17.68%. They have had a really nice run since they bottomed out after a pretty lengthy downtrend. And basically since the lows to where they're trading now, they're up about 42%. When it started bottoming out, I went overweight on this particular holding. And now that it has reached the levels where it has now, I'm beginning to trim that back to equal weight. They are trading above an upward sloping 21-day, 50-day, and 200-day. They are currently trading about 23% above that 200-day moving average, and they're trading about 8% above the 50-day moving average. They were overbought on the RSI. They have pulled back and held the 60 line at the moment, but we are beginning to get a sell signal on the PPO. They were in distribution and have been. It looks like they begin to be accumulated back in December, and that has moved slightly higher. The money flow is currently in neutral condition. I have a stop loss or a trim point on them of $114.37. They do pay that dividend of 5.62%. They have a 5-year dividend growth rate at 10.18%. So given the UPS valuation and the current prices, I plan to trim this position by about a third over the next few weeks, and I did start that with the 10% reduction this week. We'll look at the valuation in fast graphs shortly. We go to the weekly view. We can see they closed down about 0.75%. They are still in overbought territory, which over the previous 3 years we have not seen them move into an overbought condition. We've had a buy signal on them since about the 13th of October, and it still looks fairly strong. Accumulation is at 3-year highs. Money flow is still bullish, but I'm a little concerned about the valuation at this point. If I go into fast graphs and look at UPS, they have an EPS yield of 6.13%, a dividend yield of 5.62%. They've grown their earnings over this time frame at 3.57 times. That gives them a fair value ratio of 15 times and a normal PE ratio of 16.92 times. They had been trading under their fair value since March of 2025. They have recovered that. They're now trading above their fair value and getting closer to their normal PE at this point. We can see that before this downturn, they were, or I guess it was actually in the downturn, they were trading slightly above their normal market multiple, but I think the risks are increasing at the moment, and that's why I want to reduce my portfolio back to equal weight on this name. If you found this video helpful, please remember to subscribe to the channel and set notifications for future videos. Also, be sure to press that like button to help support the channel. I wish you the best in your investment journey, and remember to trade well. We'll talk to you again soon.